Well, we're quite lucky to have a number of speakers who are actually wading into and potentially even making money in the crypto world. And our first speaker from the industry is Paolo Ardoino, who is the Chief Technology Officer for Tether. As we just heard, Tether, the most successful stablecoin so far. And Paolo will give us a peek behind the curtain of Tether. So without further ado, Paolo should be showing up on the screen. There we are. Paolo, welcome, and over to you.
Thank you very much, everyone, for being here and for giving me the opportunity to talk today. I'm Paolo Ardoino. I'm CTO at Tether and Bitfinex. And today I would like to present to you the case of Tether, the first stablecoin in the market and also the biggest stablecoin in the market. So let's start a little bit with the history of Tether. So why stablecoins were born, right? Tether actually is the company that created the stablecoin industry back in 2014. The reason back then was that there were just few crypto exchanges that were trading mainly Bitcoin. In 2014, the panorama of the different of the technology of and the financial infrastructure of crypto was completely different than what we see today. So in 2014, there were 4 or 5 exchanges. There was Bitfinex, Coinbase, Kraken, and OKCoin. Not much else. And the industry, the crypto industry, especially the professional trading crypto industry, was suffering from huge difficulties in settling trades. The main issue was that in order to settle trades, in order to perform the activity of the arbitrageur, traders had to move dollars and Bitcoin across multiple trading venues. So, as you well know, the arbitrageur as a trading strategy has to sell, in the case of Bitcoin, has to sell Bitcoin where on the exchange where the price is higher and buy back Bitcoin on the exchange where the price is lower. In order to do that, this arbitrageur has to send Bitcoin on the exchange where the price is higher, sell these Bitcoins there, and with the dollars that are coming out from that sale, has to move the dollars back on the exchange where the price is lower, and so on and so forth. But if Bitcoin moves or you can move Bitcoin across trading venues within, I would say in general, around 10 minutes to 20 minutes, depending on how many blocks the exchange is happy to wait in order to create credit your Bitcoin transaction. On the other side, you have the dollars that have to be moved across different trading venues. And with dollars, it might take, or it was taking in 2014 between 1 day and 5 working days. And you can see how a professional trader that wants to arbitrage, that want to exploit the inefficiencies of the markets, was completely impaired into its activity due to the slowness of settling dollars across trading venues. So the reason of Tether was just to simply put a dollar on a blockchain. So we use the brilliant technology that Bitcoin introduced to the world, but instead of moving Bitcoin, move dollars. If you think about it, it's extremely simple as an idea, right? And the way it works is also extremely simple. You send, Tether as a website, has a platform. You send you register on this platform, you perform all the KYC and AML processes. So you get fully onboarded, right? So of course, Tether deals with banking rails, deals with regulators. So it is important that before accepting any customer on the Tether primary market, this customer is completely vetted and approved through thorough processes. Once that process is completed, then the customer can finally participate to Tether issuances and redemptions. In order, for example, to acquire new Tethers, the customer has to send a wire to one of Tether bank accounts. When the wire is received, is confirmed, then Tether will issue the same amount of dollars, but in stablecoin form, in cryptocurrency form, back to the user, and will send these tokens on a blockchain address. Of course, I think is well known that our most popular product is called Tether USDT. That is the dollar flavor of Tether. So that represents around 97%, 98% of the entire market cap of Tether products. Tether USDT currently counts to $65.5 billion. So when a customer wants then to redeem, for example, Tether USDT, let's say that it has $100,000 or 100,000 USDT, the customer just send this USDT back to Tether Treasury asset on a blockchain, and then Tether will send back a wire. This process has, of course, a small cost, that is a fee. We have a issuance and redemption fee that is 10 basis points. The reason, of course, of having a fee is to ensure that the business model of Tether remains viable even with lower interest rates. So now I want to talk about the current crypto markets and how stablecoins are fitting into these crypto markets. So we all know what happened. I think that we all know what happened, or we heard what happened in May and July 2022. That was the famous stablecoin called Terra that collapsed, right? So I want now to talk about the differences between a stablecoin like Tether that has a portfolio of liquid assets that track the underlying national currency that it want to represent. In case of Tether, USDT is the US dollar, and something like Terra that was a stablecoin created really out of thin air. So Terra was a stablecoin that was called an algorithmic stablecoin. So you can see that there is a different category between algorithmic stablecoins and asset-backed stablecoins. So this algorithmic stablecoin called Terra was aiming to maintain the peg with the dollar through an algorithm that was involving, as a part of the backing of this stablecoin, another token that the same group of developers and created, that was called Luna. You see how this, so if you create a stablecoin, so a product that should track a fixed price or should track a specific currency, another currency, and use as a collateral another token that you created, right? And this token is spread all around the world, and you have a ton of people buying this token. If someone starts shorting this token, then if that token, so this token would be Luna, if this token is part of the backing of your stablecoin called Terra, means that in order to protect the peg, you have to sell even farther, even more this token, so Luna. So this, in fact, in May caused a cascading effect, completely exposing Terra to an attack from short sellers that were selling short Luna, forcing the Terra Foundation to sell additional Luna in the market to trying to maintain the peg with the dollar stable. Of course, that was a recipe for disaster and completely failed. So it failed in 3 days, and left many traders, many retail, and but also many institutions completely harmed by the situation. On the other side, you have Tether, that is a stablecoin that has a portfolio that is extremely liquid. So the portfolio that counts, as I said, around $65.5 billion is a portfolio that is composed by 82.5% cash and cash equivalent, of which the majority is U.S. Treasury bills. You can see that with U.S. Interest rates going up, that is, of course, a good return opportunity for Tether. And on the other side, the reminder is assets that are extremely liquid anyway. So they are not, I think that before we heard about the tail of FTX and FTT, right? There is nothing like that in our portfolio. Everything that we have is over collateralized, is fully liquid, and plus Tether has and owns a cushion of additional equity, additional dollar portion to protect even further the stablecoin. So not only Tether is 100% backed, but also Tether never issued a dividend. Every dime that was accrued by Tether is kept in Tether in order to protect even further the stablecoin from possible attacks. In fact, recently, Tether was subject to attacks similarly to Terra. Publicly, short sellers trying to depeg Tether and create potentially a bank run on the markets. That was, after the fact, and was quite interesting to see, right? So to me, is the best representation of the strength of Tether. So put it simply, we have seen short sellers, so funds that were starting to sell Tether at subpar on a few exchanges. So subpar means around $0.995 dollars. So around 50 basis points as discount. So the reason to do that was to trying to create panic in the market and cause market makers to come and on those exchanges buy cheap Tethers and come and then go to Tether as a platform and redeem them for $1, right? And if you continue to do this in a loop, you can see how this can cause enormous amount of redemptions, because if you keep putting pressure on the price of Tether across different exchanges, you cause this activity made by market makers. But Tether is built different, right? So Tether, as I said, has extremely liquid assets, of which the majority are U.S. Treasury bills and cash equivalent. So what happened there is that in 2 days, so 48 hours, Tether was able to redeem $7 billion to its customers. Of course, redeem for each Tether token was redeemed at $1, so correct nominal value. And in 30 days, Tether was able to redeem $20 billion, that was 25% of its reserves. $7 billion in 48 hours was 10% of our reserves. Now, the first question is, which bank or which financial institution can match this ability of redeem so fast, such big portion of its reserves? And Tether, by the way, could have gone farther than that, right? Again, our portfolio is extremely liquid, so we could have, if we were pushed farther, we would have honored redemptions, in the same way. So to me, this represents the testament of a stablecoin built completely differently, right? Built to last, built to sustain, black swan events. So I heard in the previous speech the importance of regulations, and I think that being part of the company that created the stablecoin market, I think that to us is extremely important that regulations will come and especially will provide an important categorization that will to the stablecoin industry, right? We cannot afford that a person wakes up in the morning and decide to call a new cryptocurrency a stablecoin. That is, of course, unfair, and that is dangerous. That is dangerous, especially for both retail and institutional. So of course, we are now we proved ourselves many times, despite all the just to be transparent, open here, despite all the FUD that has been put through over the years. Tether is basically the one of the few companies that proved to have a proper and safe and intelligent risk management. We have seen many companies in the crypto space in the recent 4 months being completely bankrupt. Even companies that were public companies traded in the US. I'm for example, Voyager would say, but also we are seeing Genesis that has a whole of around $1 or $2 billion. We are seeing BlockFi that filed for bankruptcy. We are seeing, well, of course, FTX is everyone is hearing about it, and then there is Celsius. There are so many others, and so to us, I mean, as a company that is in the space, is in the cryptocurrency space since many years, and so many up and downs. Right, we all come from an important financial background. Myself, for example, in tech. We understand that things are especially in the crypto market, it is extremely volatile, and the more, since it's young, is even more volatile. We understand the importance of stability and what the role of a stable coin should be. Just to quickly touch on my last argument, I hope to have a couple more minutes. I would like to express my interest, but also the vision that they have of the future of stable coins. Especially nowadays, we are hearing a lot about talking about CBDCs, so central bank digital currencies. In that case, I think that stable coins, privately issued stable coins like Tether, will coexist with CBDCs. In general, my background being tech, I've been working for different hedge funds, both in London and around the world, before joining crypto. And I've seen how the financial infrastructure around, especially interbanking settlements, and in general, reconciling numbers between trading venues is basically terrible. So to me, at least when I was working in it, was in 2013, felt really kept together by rubber and bands. So I think that CBDCs could be really a way to push forward and modernize, so make a jump in technology to the banking interbanking infrastructure of 30 years. So you in this way, so using blockchain for issuing digital money. Money is already digital. The problem is that it's using digital rails that are extremely outdated. So if CBDCs are planning to use blockchains as a way to make more solid, more efficient, more transparent the interbanking settlements and the banking system in general, that's great. I also doubt that that CBDCs will issue on Ethereum, that will issue on Solana, that will issue on Bitcoin or Lightning Network, and so on. So in general, I think that the role of CBDCs is actually providing that connection between public blockchains like Ethereum and privately issued public blockchain and private blockchain that could be used by CBDCs. Thank you very much, everyone. I think that I'm due with my time, and I appreciate all your time.
Thank you, Paolo, for your interesting and exhaustive introduction to Tether. We will get you back on the screen in a minute for a panel discussion, but before we do that, I'd like to introduce Carlo Zaffaroni and Paolo Frontini, who are actually both operating in the crypto world and making money in doing so. So they will share with us the secrets of how to make money in crypto.
Morning. Good morning. Okay, I normally don't take notes, but this morning actually I didn't know what to do, and I just took a few notes actually to remind me what to say. It will be quite short because then my colleague Carlo will do a few slides. We're still going to talk about Tether, We are going to talk, if we have time, something that just popped out of my mind, something that Christine said before and Paolo said now about automatic market maker and what happened with FTX and the arbitrage possibility with DEXs and CHEXs. We are here, we've been called simply because we make a lot of money, pretty much. And the reason being we have been in crypto since 2018. We are an asset manager, we've been around for 20 years. But really, we really went into crypto in 2017. 2018, we launched the fund. I think we are the largest market neutral, delta neutral crypto fund at present. We made in excess of 20% per year over the last few years. And even this year, we're probably going to close about plus 12% on the year. And we do only ARB. We do price ARB between different currencies within the crypto eco space. In fact, I mean, this is the best environment for us because most of our competitors have been destroyed and annihilated by the market in the last few months. And we, just keeping the last piece that is the most interesting one, the links, the presentation of Paolo with Christine afterwards. I will leave the word to Carlo. I will show you just a few slides regarding how really works actually the arbitrage on centralized and decentralized exchanges on Tether. We have other slides, but will take too long, and we'll may speak about something else later on. I leave it with Carlo, and I'll sit there, Stan. That's okay?
Okay, this is the first slide, basically. Christine and Paolo already told almost everything about Tether. I just wanted to add one thing, how to buy and sell Tether. You can do this in two ways. You can do it directly via Tether. So you send dollars to Tether, and you create Tether, or you can send Tether and redeem them for US dollar. Otherwise, you can just buy and sell them on the markets. The difference is that when you buy and sell Tether using Tether Limited, the price is fixed because you pay just 10 basis point commission fees, while when you're buying and selling Tether in the markets, it depends on supply and demand. So it might happen that due to news flows, trade flows, or shortage or market liquidity, like when banks are closed during holidays or weekends, it might happen that the prices in the centralized and decentralized exchanges varies, and it can go to a premium or at a discount, and this for us is like an arbitrage opportunity. Now, let's see the first example. This is the centralized exchange case. We start having the US dollar in our bank account. If we see that in the centralized exchanges, the USDT is traded at a discount, which is more than 10 basis points, for us it's an arbitrage opportunity because we will be able to redeem them paying just 10 basis points. So the first thing we do is we send the US dollar from our bank account to our account at the centralized exchange, which basically means Binance, Coinbase, or Bitfinex, and it used to be FTX as well, but not anymore. So basically, we send the US dollar to the centralized exchange where we can buy USDT at a discount. When we have the balance of USDT, we just send them to USDT to Tether Limited, where we can redeem them for US dollar that will be credited to our bank account. And so we can do the cycle more and more until the price of USDT will be at the level where we cannot arbitrage it anymore, which is 10 basis points below par. So basically, this was the centralized exchange case. You can do this in the decentralized space as well. It's basically identical to the centralized exchange arbitrage. The only difference is that in centralized exchanges, you can just move dollar during banking hours. You cannot do it during bank holidays or weekends. In the decentralized exchange, thanks to Aave and other lending protocols that Christine explained before, you can just use collateral, other cryptos like Ethereum, staked Ethereum, or Bitcoin. You can send them to the lending protocol. You can use them to borrow other stables, for instance, USDC. At this point, you just send the USDC to a decentralized or a centralized exchange. You swap them for USDT if the price of USDT is below 10 basis points below par. And then you just create a USDT balance, you send them to Tether, and you redeem them. Then you will have to wait until the bank reopens for the Tether to send the US dollar to your bank account. So basically, if let's assume you could buy USDT 13 basis points below par, and you can redeem the USDT directly via Tether for a fee of 10 basis points, you are making a profit of 3 basis points, which might seem like nothing, but we prepared this slide because every day we are used to think about daily basis points. And to be honest, if you analyze the return, it's going to be, I mean, if you're going to do just a 3 basis point profit on a day, annualized, it's going to be a double-digit return of almost 11%. While let's assume if you are able to do arbitrage and a profit of 5 basis points per day, you're going to get a significant return of 18% over the year. So, you know, basis points might seem like nothing, but if you analyze the return, it's going to be a lot. Now we have a last slide. These are a few, the main arbitrages we do in the centralized and decentralized exchanges. To be honest, we could talk about all of these like for ages. So we thought that it was more interesting for you just to make questions, and we will try our best to answer any questions related to this USDT ARB, to these ARBs, or anything you want to know from us, or Paolo, of course.
Actually, no, I want to, if I may, Carlo, okay.
Right.
I want to explain something that popped on my mind when Christine and Paolo were talking about probably something that could interest. Does anyone know what it was Mango Markets here? No one. Okay. Now, Mango Markets was a lending. Do you know what it was, Mango Market? Mango Markets was a lending and borrowing protocol like Aave. Aave, I don't know, I mean, Christine mentioned it before, is the largest lender and borrowing market actually on decentralized finance. Now, as Christine said, you can go there if you have stable coins, Bitcoin, Ethereum, whatever, and park it into this protocol, and they give you an yield. And for people who actually needs to borrow instead of this stable coin or this Bitcoin or Ethereum, go there and borrow as well. Now, Mango Market was a smaller version of Aave. Now, Christine said before, correctly, in fact, that there are actually no risk to Aave itself from a point of view of lending and borrowing, because this algorithm actually adjusts the interest rate between the lending and the borrowing to make sure that people have incentive to put money in or to borrow. But the issue on this, there is a risk, in fact, apart from the protocol risk itself, that is the market manipulation. Actually, this is we probably link with regulation afterwards, and maybe Fabio Panetta afterwards will touch on this point, is that who is going to decide exactly how good is the collateral you're actually parking on this platform? Because the algorithm most of the time they assume that most of these tokens are liquid enough to absorb shocks. So in fact, Mango Markets had a native token, and this will link to what Paolo was saying about Terra and Luna, because if you think about this ecosystem, everything that happened in the last 6 months is always the same issue. We have one token that normally is a native token on the protocol. It was Luna for Terra Luna, it was the Mango token for Mango Markets, and for FTX was the FTT. That is actually very, very liquid. It looks liquid, but it's not liquid, pretty much. And is collateralizable, if I may use this term in English. So you can actually park this token, and you can borrow against this token normally up to 80%, 70-80% of the value of this token. And this value of this token, as Christine said, every 6 seconds is grabbed from these oracles. They're simply bots that they look around for prices on centralized and decentralized finance, and they use that price to tell you what is the actual loan to value that you're having parking this token on the protocols. I'm sorry if I'm going to lose you on this one here, but I'll try to make you as simple as possible. Now, what happens on Mango Market, the attack on Mango Market was one guy arrived, one hedge fund, it was not us on this one, arrived, and what he did is he collateralized stable coins, or Ethereum, I think he collateralized stablecoin, USDC as a matter of fact. He borrowed from the protocol all the Mango tokens, okay? What happens when you borrow all the Mango tokens available on a specific protocol? The interest rate on the protocol goes very, 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 very high. So bots or arbitrageurs or whatever go around buying this Mango token to be parked on the protocol. So buying the Mango token automatically increase the price of the Mango token. The oracle, that is the one that look around to decide what is the loan to value you can have on that collateral. Actually, if you remember, there was a chart that Christine showed, and when your L factor went below 1, it means that what you have borrowed worth more than what you have actually parked as collateral. So you go in liquidation mode. But the liquidation mode actually starts a feeding loop in which the price of the assets the actual liquidator needs to buy to liquidate you keep going up. In this case was the Mango token markets. Now, if the price keep going up, the protocol Aave in this, well, Mango market in this case, and Aave could have been, because there was an attack like this a few months ago, could end up with what is called, a bad loan pretty much, because eventually the attacker with another account, what he does is he actually collateralizes the Mango token that he borrowed on stage 1 and borrow much more of a stable coin he has parked on stage 1. I've lost you, I think, here. The bottom line is that manipulating the price of a very liquid token, you can actually extract value from these protocols on DeFi. So they could look safe, but they are not safe pretty much. Now, with FTX specifically and the FTT token, it happened in a way the same thing, because in reality, we are all working in traditional finance, and somebody mentioned the CME. On the CME, if you establish a position that is normally above 5% of a CME, you get your broker or your clearer that is going to ask you for more margin compared to the standard margin of a CME. So let's assume on Bitcoin, I have 2 minutes and 41 seconds. Okay, let's assume on Bitcoin you have $20,000 per Bitcoin. Now, if you start establishing a position that is over 5% or 10% of a CME, your broker is going to call you up, is going to ask you for twice the margin. So, because the larger the position, the riskier is the liquidation, the impact that you will have on the market or liquidating your position. So they ask you more collateral. In decentralized finance, at the moment, there is nothing like that. So the larger the position becomes, is still valued like, you don't need to post more collateral. Now, the FTX debacle was exactly this. The guy he exploited this opportunity of collateralizing the FTT token. There was a native token that they controlled, that they thought about controlling it. And actually, regardless of the position of the Alameda, there was the sister hedge fund, they didn't ask for more collateral for the gigantic position of FTT token that they used as collateral in the first place. So the story about FTT, FTX, or whatever that is on the papers right now is a bit of a joke. If I make a little parenthesis here, when you read that the guy didn't know what he was doing, this and the other one, he knew exactly, because he actually did the same thing that the attacker did on Mango markets a month ago. He just simply thought that nobody knew. Nobody would have known actually what he was doing. And unfortunately, the guy from Binance discovered it in the first place and actually kickstarted the death spiral. That was what we saw in May with Terra Luna. Exactly the same thing. I have 1 minute. I think I finish here because I think I've lost you, all of you actually, when we were explaining how to arm the Mango markets.